Welcome to The Explainer. Today we're looking at why the banking system wants you to stay in debt. Now I know that title sounds a little dramatic, but I want you to consider something. What if everything you think you know about debt, everything you've been taught about how borrowing money actually works, is completely wrong? We're going to unpack the hidden architecture of a system that most of us participate in, literally, every single day.
I really want you to just process this question for a second. What if your debt isn't actually a mistake? We always beat ourselves up over our balances, right? We think we just lack discipline, or we failed at budgeting, or we bought too much coffee, but we really need to challenge that deeply held societal norm.
What if it's actually the product? Think about it. What if the financial system around us was just never designed to make you financially free? The crazy truth is, from the perspective of a massive financial institution, your financial independence is actually their worst-case scenario.
Because here's the uncomfortable truth. A debt-free person is incredibly hard to profit from. When you don't owe anything, you aren't generating yields for anyone else. But a person with monthly payments? Wow, they are a perfectly calibrated machine. A machine that literally prints money for someone else month after month after month.
Okay, let's dive into this. Part 1. The debt product illusion.
To really understand how we get trapped, we have to look at how everyday payments are disguised as just success. Every single day, millions of us wake up owing money. You've got the mortgage, the car payment, the credit cards, the student loans. And the really brilliant illusion here is that people look at this trap and mistakenly believe, oh, this is just what adulthood looks like. We've been completely conditioned to think that constantly owing money is just the baseline reality of living in society. But guys, it's a trap.
Moving on to Part 2. The math of borrowing.
Now, what's really interesting about this slide is the math. See, the banking system doesn't need you to be rich. It just needs you to keep paying forever. So imagine you borrow a flat $20,000 loan. It seems super straightforward, right? You borrow the money, you pay it back, you move on with your life. But that is entirely wrong, all because of one mathematical concept working silently in the background.
And that concept is interest. I want you to completely redefine how you think about this. Banks don't just lend money. Actually, scratch that. It's more like they sell time, and then they charge you rent on it every single month for decades. You aren't just paying for the money you borrowed. You are literally paying rent on the time it takes to give it back to them. The longer you stay in debt, the more insanely profitable you become.
And this ties right into the psychological engineering of it all. As humans, we're hardwired to love instant rewards. We absolutely hate waiting for things. Credit cards know this, so they're marketed as freedom, right? Buy now, pay later, enjoy your life today. It's wild how a little piece of plastic feels like free money until the end of the month. No physical cash leaves your hand, so your brain barely even registers a loss. The pain of swiping is virtually invisible. But that pain is just delayed until the bill arrives, packed with penalties and interest. Trust me, banks understand our psychology way better than we do.
And here is where the whole shebang gets incredibly dark. Most people never actually escape this. They just step onto a hamster wheel and rotate their debt. A heavy credit card balance gets rolled into a personal loan. Then they refinance the house to pay off that personal loan. And because the underlying habits haven't changed, they just rack up new credit cards all over again. They're merely replacing one loan with another, while the bank just sits back and keeps collecting rent on their time.
It creates this really stark contrast. The average person looks at their expensive car, their nice apartment, their designer clothes, and they genuinely think they own their lifestyle. But the reality is, it's a business model built entirely on your financial dependence. Your lifestyle owns you. A paid-off customer generates basically zero revenue, but a customer carrying balances, man, that is pure gold for them.
Let's move to Part 3, Rules of the Wealthy.
Let's move to the next part and see how this all builds together, because the absolutely amazing news here is that this cycle can be broken. But first, you have to make a massive mindset shift. You have to stop thinking like a consumer and start thinking like an owner. A consumer looks at a monthly payment and asks, can I afford this? An owner looks at that exact same payment and asks, wait, how much of my future wealth is this draining?
So here is rule number 1. You must understand interest mathematically, not emotionally. Interest is completely neutral. It's just a mathematical force. It works in two directions. It is either actively working against you or it is actively working for you. You have to choose which side of that equation you want to be on.
See, the wealthy learned early on that debt can actually be a tool to make them money. They leverage it to buy assets that outpace the cost of the loan itself.
But for the average person, debt just acts like a giant vacuum that simply takes money away. Same exact mathematical force, entirely different result.
Moving on to rule number 2, avoid lifestyle inflation. This is the phenomenon that quietly, almost completely invisibly, destroys wealth over a lifetime.
Think about how common this is. You get a promotion at work, and immediately what happens? You upgrade the car, you upgrade the house, you upgrade your vacations. Your income went up, for sure, but your expenses rose even faster to match it. You upgrade everything around you, but your actual true financial freedom never grows an inch. You just become a higher-paid worker trapped in a slightly more expensive cage.
Rule number 3, own income-producing assets. This is how you flip the board entirely. So the crucial point here is learning the profound difference between things that generate cash flow and things that just take your money away. Assets pay you. A stock can pay dividends, a business generates cash flow, real estate creates rental income. Liabilities, on the other hand, like consumer debt, only charge you. The game plan is simple: accumulate the former and ruthlessly eliminate the latter.
And rule number 4, make debt temporary, not permanent. Look, if you do have to borrow, you absolutely must have a clear, fast exit plan. You cannot fall into that psychological trap of assuming you'll just figure it out later. Because let me tell you, in the banking world, later very quickly turns into years, and years quietly turn into decades of lost wealth. Never take on debt without a precise, specific calendar date for when it's going to be completely eradicated.
Finally, part 4, breaking the cycle.
As we wrap up and talk about breaking this cycle, I want to remind you, banks are not evil. They're really not. They are simply businesses maximizing their profit. That's their job. But your job is to protect your own future. So I want you to confront a mathematical reality right now. When was the last time you calculated, and I mean really calculated, not just guessed, how much interest you've paid to institutions over your entire lifetime? That number might actually shock you. Financial freedom doesn't just start with making more money, it starts with keeping more of the money you already make.
The banking system desperately wants your payments, but you should want ownership. They profit from your debt, so you need to profit from your assets. Every single dollar you control is a literal piece of your freedom, and freedom compounds exactly like interest does. So ask yourself, starting today, are you going to keep renting your time to the bank, or are you finally ready to own your future?